Most people earn money through their own labor, time to work to income. In this model, financial growth is almost always limited by a person's time, energy, and productivity. But in economics, there is another mechanism, a mechanism in which capital begins to create new capital, assets generate additional cash flow, and financial growth gradually accelerates without a proportional increase in work. This mechanism is called investment leverage. In this lesson, we will cover what leverage means in finance, how it works, why investments can accelerate capital growth, and why, in today's economy, assets often become the main source of long-term wealth. Investment leverage is a mechanism that allows you to increase financial results without a directly proportional increase in your own labor. A simple example. If a person earns money only through work, their income usually depends on number of hours, productivity, or wage rate. But if a person has assets that increase in value, generate profit, or produce cash flow, then part of the income starts forming not through labor, but through capital. This is the core of investment leverage. It does not replace work, but it allows capital to work alongside it. There is a fundamental difference between income from labor and income from capital. Salary, a linear model. In most cases, to earn more money, you need to work more hours, improve skills, or increase personal productivity. Income grows roughly in a straight line with effort. Investments work differently. Here, a different mechanism appears: capital to asset, to profit, to reinvestment, to new capital. In other words, profits are not just spent, they are used to create new assets. This is why, over time, an acceleration effect appears. Not because a person works significantly more, but because the base of assets keeps growing. One of the key mechanisms of investment leverage is compound interest. Its essence is that income starts being generated not only on the initial capital, but also on previously accumulated profits. For example, if an asset generates income, and that income is consistently reinvested, then over time the capital base increases, and therefore each subsequent cycle generates a larger result. In the short term, this effect may be barely noticeable, but over a long time horizon, compounding becomes one of the main drivers of capital accumulation. That is why in finance, time is often just as important as return. For many people, the main focus is increasing income. But from the perspective of long-term wealth, what matters is not only how much a person earns, but what happens to the surplus cash flow. There is a key difference between income that is fully consumed and income that is partially converted into assets. It is reinvestment that activates the accumulation mechanism. When profits are reinvested, the asset base increases and new assets generate additional cash flow, capital begins to grow faster than personal income. Therefore, wealth accumulation is usually not the result of a single large profit, but of a long process of systematic reinvestment. How leverage works in different asset classes. Investment leverage can operate through different types of assets. 1. Stocks and ETFs. When a person buys stocks or ETFs, they are essentially investing in businesses that generate profits, grow, scale, and accumulate capital. If companies increase in value, the value of the investment also rises. And if profits are reinvested, a compounding effect appears. 2. Real estate. In real estate, leverage often works through asset price appreciation, rental income, and long-term equity accumulation. In addition, real estate has historically also used financial leverage, meaning partial financing of an asset through borrowed capital. That is why real estate has long been one of the main tools for private wealth accumulation. 3. Business and ownership. The strongest form of leverage usually appears through ownership. When a person owns a business, a platform, a technology, or a share of a system, they gain access to the output of the entire system, not just their own labor. That is why in the modern economy, ownership is often a key driver of large-scale wealth creation. 4. Technological leverage. The digital economy has significantly amplified the effect of scale. Today, software products, content, AI systems, or online platforms can serve a huge number of users without a proportional increase in costs. This means that a single system can generate a much larger economic output than in the traditional industrial model. That is why technology companies often grow faster than classical businesses. Why leverage is linked to risk. It is important to understand, leverage does not only amplify profits, it also amplifies mistakes and risks. For example, excessive debt, weak liquidity, risky investments, or incorrect market assessment can accelerate not only growth, but also losses. That is why, in investing, the following become critical: risk management, diversification, long-term thinking, and the ability to act systematically rather than emotionally. Leverage itself is neither good nor bad. It is simply a mechanism that amplifies outcomes. Investment leverage is a mechanism through which capital begins to work together with a person. It allows you to gradually increase your asset base, accelerate wealth accumulation, and create financial growth that is not fully dependent on personal labor. In the modern economy, long-term capital is most often formed through ownership, investments, compounding, reinvestment, and systematic accumulation of assets. Let's summarize. Investment leverage is not a way to get rich quickly. It is an economic mechanism through which assets, time, reinvestment, and compounding gradually begin to work together. That is why, in the long run, capital often grows not through one-time financial wins, but through systematic asset accumulation and proper allocation of cash flow. See you in the next video.